Ladies and gentlemen, welcome back to the channel. In this video, we will discuss Tesla stock and broader markets, and specifically what I'm expecting over the next couple of weeks in the month of September. As I have mentioned before here on this channel, it's not surprising to hear September is by far, by like a long shot, the worst month for markets over the past 10 years. Like there's nothing that even really compares to September. September, on average, over the past 10 years is down 2.6%. The only other negative month over the last 10 years, on average, is December, and you're negative marginally, negative 0.2%, 0.2%. Not a big deal. So September is a standout bad month. But there's so many different things going on right now. There's this worry about the consumer one day, soft landing the next day, recession fears the next day, Nvidia underwhelming investors, causing a broadening out of our markets, the uninverted yield curve, inverted yield curve. There's a lot of weird things going on right now. And hopefully in this video, we can help provide a little bit of clarity, not to mention Jerome Powell in the next Fed meeting on September 18th. And why I think this is specifically important for Tesla investors is because, I mean, we have September, which is a seasonally bad month. Doesn't necessarily mean it has to be a bad month. We'll talk about that throughout this video. And then we have our Robotaxi event on October 10th. And Tesla at the same time is the most interest rate sensitive company out there. And it's the most cyclically sensitive company out there, which are really will be the main drivers of where markets go next. Here is if markets do well, Tesla's going to do really well in September. If markets do not do well, then Tesla's going to do really bad. I believe Tesla will just be amplified by what happens in the markets. Now, before we get into September and what to expect coming over the next few weeks for Tesla, the Robotaxi event on October 10th, like, are we going to rally into that? Are we going to sell off into that? What are my expectations? We do have some data coming out tomorrow morning, and I will share that with you now. And I will mention a lot of this breadth thrust that we've seen today. The reason why markets did well and small caps and value and cyclicals generally speaking did well today is because of the stronger than expected revision to Q2 GDP. We were expecting 2.8%. We came in at 3%. That was an upside surprise to growth, and markets like that. You also had initial jobless claims that came in at 231,000. We were expecting 232,000. So really, we're not seeing any more weakening in the labor market. These things are seen as big positives for the economy, number one, and for markets. Now, tomorrow morning, we have core PCE index month over month. You're expecting 0.2%, the same as last month. And I think the Fed's made it pretty clear that pretty much no matter what happens with economic data, with inflationary data, the Fed's going to start the process of cutting rates September 18th. So from that standpoint, even if we come in a little bit on the hot side, I don't think it matters to the market's perspective. What will be important is personal income month over month. You're expecting 0.2%. Actually, a higher number here would be seen as good because we're not expecting higher wages to produce more inflation. Okay, so people getting paid more, yeah, it might squeeze corporate profitability a little bit, but that's going to be offset with more consumer spending, which with the rate of the money supply and how fast money circulates, people spending more is going to be better on net for corporate America rather than slightly lower margins at certain businesses. That complex can get complicated, and then we're talking about really macroeconomics. And the long story short, higher income is going to be good for markets, especially during this time where consumers feel stretched and inflation has eaten away at their budgets. Now, personal spending, I think, is going to be the most important data point of tomorrow. Now, keep in mind, this is data for July. So we're heading into September, and we're just now getting July's data. Okay, the data is lagged behind something crazy here. With all of this data, is for the month of July. Now, personal spending month over month is expected at positive 0.5%. Last month, you were at positive 0.3%. If you, let's say, do get a worse than expected number there, you're going to spark more recession fears of the consumer slowing down. And that's not going to be seen as positive. So I actually think the most influential data point of tomorrow will be personal spending. And keep in mind, personal spending, people spending money, is over 70% of GDP, of the gross domestic product in this country. It's vitally important that people continue to spend money. If we do see a slowdown there, that's going to be bad news. Now, personally, I think the data is so lagged behind that it's very well possible this data says it's for July, but we're really looking at data that's like June or May in terms of what the actual consumer spending picture looked like in May and June. So from that standpoint, I'm not worried about the data coming out tomorrow. Now, are we going to get a big upside surprise? Probably not. Could we? Of course. But I'm not concerned that the house is falling apart, if you will, from the data tomorrow. I just think it's so lagged behind that even if the economy has weakened in recent months, which I think it has, we're not going to see that for a while. And that really brings me into the next segment of this video, which is what I'm expecting for the markets in the month of September. Now, it's pretty obvious September is historically a bad month for markets. You can see this here on chart. Only 30% of the time markets are actually green in September, by far the worst percentage. Just to kind of put this into a little bit of context, October, which is seen as a really bad month normally for markets, has a 60% positivity rate. And December, which has been the only other month that is negative over the past 10 years, also has a 60% win rate. So very rare to have a positive September. And just to share these statistics again, in 2020, you were negative 4.1% in September. 2021, you were negative 5.0%. In 2022, you were negative 9.6%. And in 2023, you were negative 5.1%. So your 10-year average for the S&P for September is negative 2.6%. So this would suggest that September is probably going to repeat recent history and not be that great. But from my logic of the only thing that really matters to this market is economic data, the economic data is so delayed that I think the data that we're getting is 3 to 6 months old, where the economy was holding up. And from that perspective, I'm really not worried about September's economic data, or at least the data that we will get in September that is showing us data from months ago. And heading into the first Fed rate cut, it's vitally important how investors feel about the economy. Right now, there's a 0% chance of a recession. That is factual. The markets are not pricing in a recession. We're pricing in the best case scenario. Now, that's fine as long as we see economic data in September continue to come in okay, in which I believe we will. In that scenario, if you break down the actual internals of our markets, big tech is the reason why there is a 0% chance of a recession, because big tech has held multiples up. It's really the area that has done exceptionally well in the last couple of years. If you look at small caps, if you look at value, if you look at dividends or cyclicals, any other area besides, big tech, it paints a much different picture. Those areas are pricing in, to some degree, a recession. Small caps are pricing in more recession than utilities, than pharmaceuticals or healthcare, but they're all pricing in a higher chance than 0% of a recession. So what I mean here is, even though broader markets are priced for perfection, if we get economic data that's good heading into the Fed meeting September 18th and the Fed cuts rates, that's just going to prompt money to move into other areas that are priced for a recession. Small caps are most priced for a recession, so they would have the most to gain. Cyclicals, they are priced for recession. Consumer discretionary stocks, consumer cyclical stocks, they are priced for a recession, probably 40-50% price for a recession. So you would see a lot of gains there as well. Now, Tesla, where does Tesla sit in this? Tesla is the most economically sensitive company, I think, the most interest rate sensitive company, I think, So that could set you up for a very strong September for Tesla. And that is as long as the economic data comes in good. I could be wrong. Maybe the economic data does not come in good. Maybe there's another existential crisis that happens. Maybe it's the yen carry trade. Maybe it's geopolitical tensions or something else. But as long as nothing breaks or starts to really go bad, then I would expect September's going to be a really good month for Tesla. So even though historically September is a bad month, I think, if people are going to make that seasonal call for September just based on that and not take into consideration any of the other points that I'm making in this video, that would be a very flawed conclusion. It wouldn't surprise me if September is actually a strong month. October or November were weaker months. December could be a weak month as well. Again, because I think by then, it's almost September. December's like 3 months away, okay? 100 or so days away. We're going to start seeing data in December, I believe, based on what the economy is doing now. What I see the economy doing now is not good. I see this from people I know. We see this reflected in many data points like delinquencies on credit cards. 11.1%, I believe, of credit cards are 90 days past delinquent. You are seeing consumers starting to really pull back. We're seeing this on earnings calls. We're seeing this, hell, look at Dollar General that is seen as value, right? You go to Dollar General, you're getting value for your money. You're not buying premium, premium price things. Even Dollar General is not doing well. I think some of this weakness will start to get reflected by the end of this year. But September could be a sweet spot for markets and for Tesla. And thinking about the robotaxi event on October 10th, if we are in a sweet spot for the month of September, which I think is totally plausible here, then you could actually see a rally into the robotaxi event on October 10th. Now, if we rally into that event, we probably sell off afterwards, and it will really depend on, the economic data at the time, what's going on in the markets, what ultimately happens with Tesla following that event. But I think at least heading into that event, there's more things working for Tesla than not. And clearly by tomorrow morning, we could have a totally different picture. If, consumer spending comes in really bad, then forget this video was ever made. But I don't think the house of cards is collapsing down just yet. And you need to use this information to your benefit. If any of this makes sense to you, let me know down below in the comment section. But the best thing you can do right now, in my personal opinion, is trim some gains where you have them. Companies that will be negatively impacted during a recession that are not necessarily priced for that, I would stay away from them. For an example, CVS, Dollar General, perhaps Tesla. These stocks are priced for recession with the upside opportunity of avoiding a recession and seeing that uptick in cyclical activity, seeing that uptick in, consumer spending behaviors as rates do fall. The areas I would avoid like the plague are areas that are not priced for recession at all. That would be big tech. That just stay away from big tech. In my personal opinion, there is no logical argument that anyone could make that would say, yeah, Apple's a great value at these prices. Hell no. Microsoft, Google, Amazon, quality businesses, the best of any business that has ever, been around in the history of the world. And if you want to own them for the long term, I understand why. They're they're going to be around, they're going to do well. But you could see 50+% declines. You could see massive collapses of those stocks, whereas Dollar General perhaps has priced in a lot of that recession risk. Nike has priced in a lot of that recession risk. CVS has priced in a lot of that recession risk. Tesla has priced in a lot of that recession risk. And if we avoid a recession, again, those are the kind of companies that will see the most upside in that environment. So these are kind of just my thoughts, just putting them out there. Conclusion would be September, I actually think could be a really good month for markets, could be a really good month for September. I'm more worried about October, November, December, specifically October, November, and December, and heading into 2025. I mean, that's where things start to get a lot more dicey, in my opinion. I don't think you can have the consumer that rolls out of bed and have Dollar General just collapsing, literally a fallen angel over here, and that not get reflected in economic data. Like, things are not fine if Dollar General is falling 30% in a day. This is not what you would call bad management. This is what you would call a company that is at the whim of the consumer. And yeah, it doesn't look great. So these are my thoughts. Let me know what you think down below in the comment section. For anyone that wants to know on pure speculation where I think Tesla stock could go before the Robotaxi event, if all things go well, if markets continue to hold on to the soft landing narrative, if the data continues to support that, if the Fed cuts rates and sounds very accommodative, then I think Tesla stock could rally into the 300s, at least to the 300s. The 280s would look more reasonable because that's kind of where we got close to last time. To see a little bit of a break above that into the 270s, closer to 280s would make sense with some kind of very short-term rally. Again, if things line up well heading into October 10th, that would be, you know, a better, I don't want to say best case scenario because anything can happen, but that's kind of more like the best case scenario. You know, if things get worse, September's a bad month, then I would expect Tesla's really going to trade between where we are now, call it the 220s and the 180s. When we actually go into a recession, once that narrative starts to form, that's where Tesla would go much lower. But I'm not really concerned about that in September, even though September is historically by far the worst month for equities over the past 10 years. With that said, let me know what you think about this information down below in the comments section. Let me know your thoughts on markets generally about the economic data. If you think it's severely lagged behind like I do, I would love your perspective and opinions down below in the comment section. If you guys would like to come trade with us live in real time, check out that link down below in the description of this video. For any of you guys that have signed up over the past couple of days, if that link has not worked, there is a new link provided. Go try that one and let me know if it works for you. So you guys have a great rest of your day, and I will see you in the next one.